What's going on, guys? Jay here. The video today serves as an update on the video that I posted 2 weeks ago. For some reason, there's been major sound issues with it. The good news about that is that I'm going to be making a video today with a lot of updates and answering questions that you guys had about the last video. So if you don't want to miss anything, stick through the entire video. There's a lot of gems and updates. And before you say, oh, well, this is a clickbait video about the 90% plus win rate, I will be sharing the updated backtesting data at the end of this video, and this is going to be an ongoing thing on this channel, so you're able to track it through time. The strategy that I'm using helps to see the flow of the market a lot better. I separate the sessions with liquidity highs and lows to be able to see where the algorithm is leaving pockets of liquidity to see where it wants to target them in future trading sessions. The first thing you're going to want to do is to take your vertical line marker, put it in blue, and start marking the midnight hour New York time. Now, I'm only showing this example on a few days back and today, but I encourage you to go back as far as possible. Then you're going to change the color of your line to gray, and you're going to mark out the 8 a.m., 1 p.m., and 7 p.m. hours. Now, once your chart looks like this, you are going to go in every little section and you're going to make a horizontal line on that session's high and low. You're going to want to drill down to a lower time frame to be able to do this. Now that your chart looks like this, you are going to put in red all the areas of liquidity that have been tapped into. For example, this one here was taken by the following session, so you're going to put it in red. This one has not been tapped into yet. This one has. This one is going in red. You're going to do that for all the previous liquidity pools that have been tapped into. Now your chart should look like this. The number one question I get asked is, does this work on anything else than S&P 500, like Forex, gold? And the answer is, I haven't tested on anything else. So until there's any evidence to show that this works with actual data, I can't say that it does. But what I'm showing you here is just a simplified version of seeing the smart money concepts that ICT teaches. I'm highlighting the pools of liquidity that the algorithm or the interbank price delivery algorithm is trying to target during the trading sessions. Another important level that you would like to highlight on your charts is the new week opening gap. You will find this at the candle close on Friday and the candle open on Sunday evening. This is this little gap right here. You're going to want to mark that out, and I'm going to cover this more in detail in a future video. And now our chart should look like this. People ask me, what indicators do I use for this strategy? Well, there are more of automated markings than indicators, so I use the FVG by Nephew Sam, and I use an imbalance finder dynamic. This lets me see in real time the fair value gaps that have formed and the ones that have formed but have been rebalanced out. I like to use those for future levels. So the strategy is pretty simple. You drill down to a 5-minute chart, and then you start looking for this. I created a step-by-step protocol in chronological order so that if you check all of these boxes, you have the highest probability chances of getting a win. This protocol is available to be downloaded on my website. Essentially, the strategy goes like this. This is the New York AM session from yesterday. It started here at 8 a.m. What we're waiting for is for this or this line to get tapped into. And when I mean tapped into, I mean crossed into. And then once that occurs, you wait for a reversal. And that reversal has to be a break of structure with a fair value gap that creates strong displacement. Over here, we have a wick that comes to tap into this previous session's liquidity pool. Then we have to start looking for a break of structure and a fair value gap to form in the other direction. And we have that occurring over here. So this is your break of structure. And we have a fair value gap that formed over here. Now, what's the ideal entry as per ICT or smart money concepts? We wait until we have a retest of that fair value gap, which we do here, and then we mark out our stop loss at the nearest low. I like to go nearest low versus going directly to the candle because sometimes that doesn't leave a lot of room. And then you're going to target an opposing liquidity pool, which in this case is the London high. And you have a 2.41 risk to reward. And if you took a partial here and you left the trade running, this would have been almost a 10R trade. But let's be realistic. You take a partial over here and you leave a runner, and then you trail your stop loss until you get kicked out. If we take another example here, this is the New York AM session. We see that the London high has been tapped into. So once this occurs, let's try to see if we can find a bearish fair value gap with strong displacement that creates a break of structure to be able to identify a reversal for us to take our entry. Does it happen over here? This is not a break of structure. We're still bullish. We would have to wait for a break of structure. We do have a swing low over here that gets broken through. And we do have displacement through that move. The fair value gap is here. And then we wait for the market to come back to test this fair value gap. We take our entry when it taps it. We put our stop loss at the nearest swing, either 50 fib or an opposing liquidity pool. So where would I draw the 50 fib on this chart? I would draw it from this low that's not been tapped into all the way to this high. And we have our 50 fib level, and this would be our trade. You have a 3R trade from this move right here. Here's the entire checklist for the protocol to have a valid entry. Identify the liquidity rate of London high or low, or New York AM high, New York AM low. I only trade the New York session, so I'm going to be looking at London highs and lows, or the New York AM highs and lows if I'm trading in the PM session. Identify premium and discount zones with these previous highs and lows. These are the previous highs and lows, and you have your premium over here and you have your discount over here. So ICT teaches to take shorts in this area and to take longs from this area. Avoid and or clear high impact red folder news events. This is the economic calendar that I use. You have to be on the sidelines for these red folder news. Identify liquidity grab blue line tag, then mark out the break of structure required for a valid reversal. Identify the break of structure candle body. This is an update that I made. You want to have a body go through that break of structure. Wicks do the damage, bodies tell the story, says ICT. So make sure that you are waiting to have a body cross into that structure with strong displacement and fair value gap on 5 minutes in order to validate your entry. I actually have a video about that explaining where that break of structure can be identified so that you're not getting caught on wicks for continuation moves and getting kicked out of the trade. Look for 5-minute fair value gaps to show support for the next candles. You want to make sure it acts like resistance. So once that fair value gap forms, you want to make sure that it doesn't pierce right back through it. You want to make sure your fair value gaps are showing support for the following candles. This is something I like to use as well, is to make sure this fair value gap is building up on a previously opposing fair value gap as an inversion gap. Let's see if we can try to find one over here. In the setup from yesterday, this bearish fair value gap is acting as support for the bullish fair value gap that formed after. So I try to look at the symmetry of fair value gaps that are bearish and then they turn bullish in the same areas, and that gives me an extra confluence to take the trade. I like to pre-fill the trades, stop loss, and take profit at a minimum potential of 1 to 2R. This confirms that I'm entering in positive asymmetric setups that can give me a good return even on a lower win rate. So I know that at 1140 and 1145, if I'm waiting for this trade in this area, I'm getting a 2.43 potential on this trade. So only aim for trades that have a minimum potential of 1 to 2R. It's important to let the market come to you and to follow these rules, because you can be a positive trader even with a 50% win rate. If you're asymmetrically stacked on your risk to reward, you're going to be a profitable trader. Then you enter a limit or market order when the target price is hit, and your trade has to offer a minimum 10 handles. And this is on the S&P or ES. Your stop loss should be clear of the previous swing high or low, because there's no reason for the interbank price delivery algorithm to go back there if in fact the liquidity that it was targeting has been grabbed. So it's going to target the opposing liquidity after that. Again, this protocol is available on the website. Now let's take a look at the testing results, which have been forward tested because I was taking some of these and I was identifying each and every day if one of these setups was forming. So these were actually built in real time. Now this is the updated version, so we have some June data in here. In order for you to understand what a win is, a win for this protocol is a minimum 1-to-1 risk to reward win, which means that you've taken a partial or a full close at 1-to-1. So I do identify in this column here a win as being a minimum of 1-to-1. So if your stop loss is 7 points, a win would be considered 7 points in the opposite direction. This backtesting data is available on the website. This is what I track with the spreadsheet: the day, the date, which blue line was rated, what was the algorithm aiming for after, did we get a win or a loss, was there a fair value gap formed on the 5-minute candle. This protocol requires that to happen. As of today, I'm going to start tracking the time that the fair value gap was formed so that in the results you're able to see that more clearly on your charts as well. I'm tracking if they were silver bullet hours between 10 and 11 a.m. or 2 to 3 p.m. I'm also going to start tracking the entry time. So you're going to have which fair value gap is giving you the signal, and then what is the entry time. Did the move create 10 or plus handles or points? Was this trade a 1-to-1, 1-to-2, or 1-to-3? And then I have personal notes here. And then I started tracking my psychology behind these trades. So these are all valid setups, but sometimes I don't take them for some good reasons, some bad reasons. So I just started to track the reason why I did not take those trades, or maybe because I was a little paper hands and I closed the trade before I actually should have. So how much did I leave on the table? This trade in blue is a trade that I took, which I live stream on YouTube. So I do have a video about this specific setup here. So at the time of this recording, this strategy has produced 53 trade setups. We started looking at these in April all the way until yesterday, and we have 51 wins and 2 losses for a 96% win rate. Now be careful, win rate does not equal profitability, but in this case, we are showing you that a win is a 1-to-1 minimum risk to reward, closed trade or partial, and then you can see that some trades are going much further than that. And we're aiming at 1-to-2s. So if you took your partial at 1-to-1, you moved your stop loss to break even, and then it came back to hit your stop loss and did not continue, that is a win. You have a partial win. I'm going to include at the end of this clip a live silver bullet trade that I took using this strategy. And if we just want to recap on what we've learned today, is if you draw your midnight candles, your separators at the times that I gave you, and you draw up those liquidity pools, blue means it hasn't been tapped and red means that it has been tapped. The algorithm is going to look for those liquidity pools. So what you're trying to do is to wait for the blue line to get tapped into in your session, and then you look for a reversal, which consists of a break of structure with a fair value gap with strong displacement. And then once the fair value gap has been printed on a 5-minute candle, you wait for that fair value gap to get retested, and then you place your stop loss at the nearest swing. In this case, it's a swing low, and you target an opposing liquidity pool that has a blue line on it that has not yet been tapped into, and you aim for a minimum 1 to 2 R before you actually pull the trigger on that trade. And if you do this consistently, you will have success and you can expect exactly the same results. So guys, if you enjoyed this video, please give it a thumbs up and consider subscribing to the channel, because there will be a lot more content like this. I am dynamically showing you this strategy and updating the results on the spreadsheet. You can download this protocol on the website for free. And if you follow this strategy and you have good compliance to this strategy, this will change your trading game. So as mentioned, this is the trade in the spreadsheet that is highlighted in blue, which I live streamed. Both blue lines got rated at the bottom. So I'm looking for a break of structure that would give me a confirmation of a reversal. And we see that there's fair value gaps that are being formed, which is a synonym of strong displacement. So I'm placing a limit order on the breaker, and this is not being very patient. Sometimes I'm afraid to miss the trade, and I take it on a structure instead of following the checklist to the T. And like I said, compliance breeds results. I'm not a perfect trader. I still have some stuff to work on, and patience is one of those things. You can see the market going against the initial position that I took. I was still confident because I knew that this was a pretty big fair value gap, and it was printed on 15 minutes as well. It was creating an inversion gap with the previous bearish fair value gap. So I wasn't scared to see the trade going against me to my stop loss. This is where I should have taken the entry, because this respects 100% of the protocol. We're right now in the fair value gap. We're seeing some resistance. So this was the optimal entry for this trade, and the risk to reward would have been absolutely insane on this. I went away from my screen for a few minutes, so when I got back, this is what I saw. So now the market is going in my favor, and I'm targeting a few different things. And target one is the high of the previous session, which is the London. So I'm going to take some off at that target, which occurred. And then I have two other liquidity pools, and you can see that they're highlighted in blue. So I have target 2 and target 3. So some money is going to come off at those levels as well. I think it's interesting to see, even if this is sped up a little bit, what the candles are doing, because as a beginner, you can feel very excited or very scared when the candles are printing. And with experience, you're going to see that it only takes time for the market to go where it needs to go, and it's going to show you a bunch of different things to put traders into trades that they shouldn't get into. There could have been a very bearish candle at this time that could have been just a wick tapping into that FVG again for another entry. But essentially, you just have to be confident about your risk to reward and the probabilities falling into your favor over a certain number of trades. So when you pull the trigger, just follow your plan and don't start playing with the trade while it's executing. And I'm guilty of this sometimes. That target 2 sometimes would have been my full TP or my target 1, but I'm working on being better with my entries and being more patient. If I think the market is going there, I'm usually right, but I cut some of the profits short. As a beginner, this is where I probably would have closed everything and left some money on the table. And it does happen sometimes depending on how I'm feeling for the trade setup. But in this situation, I felt pretty confident that we could go higher. See, at the exact same moment, I start writing that I'm not really a fan of what I'm seeing. It's past 11. You're just trying to convince yourself that it's the right time to close this trade. And, this is a bit of resistance, and you have to be uncomfortable sometimes to really, get the juice out of the lemon completely. Or else, like I said, you're going to play with the asymmetric risk reward that you set out of 1 to 2 or 1 to 3, and then you're going to need a much higher win rate in order to hit your profitability targets. So TP2 has been hit, and now we have a third target that's identified on there. And see how I moved that third TP. I had it initially at the top of that green zone, and this was taking long, and this was the middle of the new day opening gap, and I was thinking to myself, maybe that was the final push. So when I saw the candle print, I put my TP right on that wick, because if ever there was going to be a reversal at that zone, I wanted the liquidity at the top to be grabbed before it made its real move back down. So I was pretty confident that where that TP is right now at target 3, even if the market reversed, I am pretty confident that it would have wicked in there before it actually went down. My stop loss is trailing, so I'm moving it as the market is moving in my direction, and this is a joke. Obviously, the magnet doesn't help, but I like to use it in some of the videos. It just shows like the draw on liquidity. And then, yeah, I didn't want the market to go back under that candle. I was trailing pretty tight, but I felt that we were making a final push there. So I was ready to cut the trade if it went back down, even without grabbing that last liquidity at target 3. Some other people have written to me about the magnet thing, and they say that they've done that in the past too. So hey, whatever works for your psychology. And then we hit target 3, and we are completely out of the trade. So again, if you guys found this helpful, please give the video a thumbs up and consider subscribing to the channel. Thanks and have a great day.